depreciation is massive. Usually the second or third biggest rental deduction, and it's probably the most overlooked claim as well, by virtue of it being, it's not a cash outgoing. So you can't go into a bank statement and find it there. It's not something you fork out.
Yep.
And then you can't find that in a rental summary from real estate as well, because it's not there. It's just to account for the decline in value of the property. So to access that claim, you would need to engage in a quantity surveyor. If you're not sure, ask your accountant, and then they can talk to the quantity surveyor on your behalf. And basically, if your property is within 40 years of construction, there would be something there. And obviously, the newer it is, the more depreciation there is for you to access.
Yep.
And so consult with a quantity surveyor. They would draft a report for you, and then it would make a massive difference to the bottom line.
Good day everyone, and thanks for joining me in another episode of the Mortgage Chat. Today I have a very intelligent person who specializes in the field of accounting in the name of Jamie Kwok from JMK Partners. Thanks for joining me, Jamie.
Thank you, Tony. Thank you for having me.
So Jamie, just so our audience will know, can you just explain a little bit about what you do, how long you've been doing it for?
Yeah, so I'm a tax agent and CPA. I've been doing it for just over a decade altogether. So I started initially out of uni and in a small suburban firm, and went on to open my own practice.
Yep.
So yeah, altogether more than 10 years.
More than 10. And how long have you been operating your own practice for now?
Since 2017. So it's been 6 years.
Yeah, nice.
It's smooth sailing since.
Yeah, you've been loving it?
Yeah, it is good. The autonomy and then the ability to help clients definitely is something that I like.
And man, how did you actually fall into accounting?
I fell into accounting because I think I have been I've been a numbers person.
Yeah.
Like growing up, I do enjoy that aspect. Accounting because I do enjoy educating people about money, and then also just thinking about building a career of helping people manage their finances and helping them get better. And then also just from everyone saying, accounting is it's recession proof. Like it's, everything goes pear-shaped. It's a profession that is quite safe. So that's how I started. So year 10 work experience, that 1 week, went to my dad's accountancy for his old accountant. We did 1 week there. I was pretty, I knew what I was doing, but yeah, I didn't know for what purpose or anything like that. But looking back now, I was actually doing a business activity statement. So they put me in a deep end straight away, which is, which I really appreciate. And then did the economics in uni, did an economic degree with a major in accounting. And then, just suburban firm out of uni, really enjoyed it. Work was quite good, had quite a bit of client exposure. Yeah. And then just went on to, figured that I wanted to do my own thing, and then went on to open JMK Partners in 2017.
It's always the progression, right? You've worked for somewhere for a certain time, learned the business, learned the operations, learned the logistics on the back end. It's like, you know what, man, I'm going to do it myself.
Yeah. I think in accounting it is that sort of progression. It's just the ability to have your own clients and then just have your own relationships and then managing that long term. Yep. And it's very rewarding.
Yeah, good. And what sort of clientele in your business right now? So tell us a bit about your clients.
I'd say 3 distinct groups. Yep. I'd say individuals. So individuals wanting to do their tax returns. So usually once a year, we help them with that. And then there's small businesses. Small business, there's a lot more touch points throughout the year. So they need support throughout the year, so we help them with that. And then the third group is investors. So investors, they fall into the first 2 as well, but they would have assets invested, so property, shares, managed funds, cryptocurrency, and so forth. And then so they get support as well.
So look, we are towards the start of the 2024 financial year, right? a lot of people, are chasing up for the tax returns to be done.
Yeah.
Right. The last 12 months, we've seen a lot of interest rate rises. Okay, especially, and it's hurt the investors a fair bit, right, in relation to, the interest they have to pay. Are they hitting you up to do their tax returns a lot faster so they can get the tax returns back?
Yeah, absolutely. So,
are you seeing, consumers getting hurt?
Yeah, definitely. You can see the interest rates go up when you do you can do the tax returns. You sort of they get in touch earlier. So that's the first thing.
Yeah.
So the guys who know they're getting refunds typically getting in touch even earlier, and then even more people wanting to just access the refunds, putting it back into their offset accounts.
Yep.
And then going and reducing the interest that they have to pay. And also you see the guys that sort of been on the sidelines for a little bit with purchasing. So during the rate rises, a little bit apprehensive, but now with a little bit more confidence in the market, they're getting back in and then getting the returns underway, especially business owners, getting their financial statements and then tax returns, and then assessing borrowing capacity. Speaking with the broker, and then you're talking about how much they could potentially borrow, and also refinances as well. Like get guys coming from low fixed rates going into variable, and there's a big jump, and then wanting to see if they can get a better product.
Yeah,
and then if you run a business, you have to get your returns done.
And you see, right, because you see, especially for individual investors, all right, you see them. Look, you know the numbers left, right, and center, right? And you see how much interest they're paying, how much they're forking out of their own pocket, etc., etc. Are you scared for certain investors out there in the market that's loaded too much?
I think investors, some investors have overextended. You do see it, but actually there hasn't been too much conversation in regards to having to potentially having to sell property.
Not yet.
Which is no, not yet. And I think the major banks have come out with their CEOs saying they've people been saving for a rainy day for quite a while, and they've had quite a bit of a kitty built up. So I haven't really seen too many of those having to do a fire sale or anything like that, which is definitely good for the market.
So you touch a bit on what you specialize in and what sort of clientele you deal with. Consumers which loaded up the last 2 years, 3 years in debt, buying investment properties and all that, they most likely would have purchased a property at very, very low rates when times were good.
Yep.
So now obviously the rate's gone up by 4%, and it's hurting them a fair bit in the back pocket.
Yep.
So what are the sort of things that you can sort of advise these consumers to sort of soften the blow a little bit?
Yeah, so specifically in their tax returns, it's the most obvious thing, but claim the interest. That is, it's the biggest rental deduction for a lot of people. But to do that accurately as well, you won't believe how many people still put down repayments. When they claim the interest, they think it's actually the repayments that we put them. So it is the biggest deduction, but do it correctly. So that's something that's something not to be missed. And another thing is often overlooked is borrowing costs. So if you got a new loan, or if you had a refinance, to set that up, there would have been some costs involved. So those are your loan establishment fees, valuation fees, and sometimes if you borrow a lot of money, there's LMI as well.
Yep.
And then also your title search fees. So those things are claimable, and sometimes they get missed because they fall in the first page of the loan document on the loan statement. So people typically miss those, but they are claimable.
Right. So at the end of the financial year, what you're saying is, hey, if you have an investment loan, the bank should have an end of financial income statement that shows how much interest they've paid, right?
Exactly. Or if you just access that actual loan statement, that the loan document, it'll document the fees involved.
Yep.
And then basically there are a number of them that can fall into your tax return to lessen the blow.
Yep, correct. Because it's the settlement letter that we get at settlement, right?
Exactly.
So at settlement, the bank should, or your lender should give you a breakdown of your costs for exiting the bank. So it could be, government fees. I'm not too sure if governments can be claimed. But, it should be discharge fees, valuation fees, total search fees, doc fees, legal fees, all that.
Exactly.
Right?
And then if you don't know it, like, or you can ask the question. I think the conversation, if you prompt the question, and if you can't find it, ask your broker or get the bank statements and then give it to your accountant. And then there's something there. There should be something there. And then I think the other thing is depreciation. Depreciation is massive. It's almost it's usually the second or third biggest rental deduction, and it's probably the most overlooked claim as well, because by virtue of it being it's not a cash outgoing, so you can't go into a bank statement and find it there. It's not something you fork out. And then you can't find that in a rental summary from real estate agent as well, because it's not there. It's just to account for the decline in value of the property. So to access that claim, you would need to engage in a quantity surveyor. So if you're not sure, ask your accountant, and then they can talk to the quantity surveyor on your behalf. And basically, if your property is within 40 years of construction, there would be something there. And obviously, the newer it is, the more depreciation there is for you to access. And so consult with a quantity surveyor. They would draft a report for you, and then it would be a massive it would make a massive difference to the bottom line.
And we have a podcast in relations to quantity surveyor as well, dual tax. So if anyone that haven't looked at that podcast or listened to that podcast, please have a listen to it. And dual tax should be able to help you out there as well.
Yeah, they're one of the big guys.
So you touch a bit about LMI there. Now, can LMI be claimed for the life of the loan, or is there any a certain period that LMI can be claimed?
LMI is a borrowing cost, so anything over $100, you portion that over 5 years.
Okay, you just touched a bit about depreciation just then, right? About you can claim that back. Let's say, for example, I purchased a property, 5 years ago, and the whole 5 years I claim total of $30,000. On those deductions. Okay, so what actually happens to that $30,000 that I claim back when I sell the property?
So when you sell it, so with the depreciation that you claim, it's going to be split into two parts. So one is plant and equipment, and the other one is the capital works, which is structural improvements. So basically, the structural improvements or the building cost needs to be added back when you sell the property. Right. So basically, in the calculation of the capital gains tax. So the capital gains tax, quite simply, is what you sell for, property, and then you minus the cost, how much you've that property, and like the purchase and all the associated costs, like you got your stamp duty, conveyancing on purchase and disposal, and then your selling costs. And then basically add all those up, but you have to take away from that the structural improvements part of the depreciation. So say, for example, if you claim across 5 years and a total of $30,000, say $20,000 represents that capital works, you have to take that from the grand total. What that means is your capital gains would go up. So there's more capital gains exposure. Right, so more taxes you have to pay. Exactly, but then there's the obvious questions. Why do you need to fork out on the report to claim the depreciation first, and then to have to later on account for that in the additional capital gains tax? And that's quite simply whenever you hold property for more than 12 months, like whether you do that solely jointly with a partner or through a trust. You hold property for more than 12 months, and then you get a 50% capital gains discount when you sell. So whatever the appreciation is, you halve that. So therefore, even if you have to add back on the depreciation and the capital works component, that would be halved. Right. So it's always better to claim. If you can access it, but then obviously, there's the time value of money as well.
Correct.
You rather
Inflation.
get like we lived in we lived in inflationary times. So if you can get $1 now, you would. Yeah, correct. Because a lot of people don't understand that, hey, you sort of have to pay that depreciation back
when you sell the property.
It's one of the really common.
Right?
It's not accounted for usually.
Yeah.
Like it's you wouldn't believe how many.
Because a lot of these, property gurus out there that try to flip off the planned properties, and they base their cash flow on with depreciation. And we've actually seen, for example, we had a client that bought for 500,000. They're actually selling it 2 years later. They sold it for 500,000, but they claimed all that depreciation back.
Yeah.
And guess what? They had to pay back the depreciation.
Yeah. It is often missed.
If you claim it back, 5 years ago, the dollar power 5 years ago is worth a lot more than today. Because of inflation.
Yeah, you don't know how much it's going to go up, like in terms of like the power bills and everything.
Yeah,
it's
exactly.
going to just, it would be like, and then you might not sell in 5 years, you might hold it for even longer.
Exactly.
So it's like.
Exactly. Jamie, as a consumer, we like to be as creative as we can.
Yep.
Right? So when you're doing individual tax returns, what are some of the things the ATO are picking up on in 2023, for example?
Yeah, 2023 property related, I would say, so specifically with rental properties, they are targeting, I guess it's like every year, it's the repairs versus improvements component. So like whenever you do works for your rental property, if you're fixing a small part of an asset that breaks down, like if you have a split system, and there's one component that breaks down and you get a handyman or aircon guy to come in and fix it, it's a repair. The cost is incurred in that year and you can claim it back in full in that year. But if you go and replace the whole thing, like a ducted aircon, it's like God knows how much, like $10,000 or more. Technically, you can't write that off in the first year. You have to depreciate that.
Really?
As per the effective life.
Wow. Is that just a recent change?
No, it's always been the case. But say that example is quite clear cut. So but you might have something that's not as costly, like a hot water system, and it works the same way. So when you're replacing something in its entirety, it's an improvement, and then you can't get the cost of it back. You can't claim it all back in 1 year. It's depreciated as per the effective life. So when you see repair bills, like if people like to claim it straight away, get the benefit straight away, and then we pick up clients and then we review in the previous year's tax return, we see repair bills of like in excess of $10,000, and it's always like, oh, fingers crossed we don't get an audit. It's
so okay. Let's go back to the example where it's a ducted aircon costs 10 grand, right?
Yep.
You just said you have to be claimed over a certain period of lifetime. Okay,
yeah, that's right.
Now, does a quantity surveyor have to update the report to account for that ducted aircon, or is that something you can do as a straight line method?
Yeah. If you engage in the aircon guy yourself, you would have the actual cost, and then you refer to the ATO effective life tables, and they have like an indication of how long they think that asset will be effective for. And then the other, another thing that the ATO are focusing on for property is the apportionment of expenses.
Okay.
So apportionment of expenses. If you take, for example, a holiday home, like you might block out, every school holidays 2 weeks at a time, and to enjoy with your family.
Yep.
So with those weeks that are not available for rent, technically you can't claim the associated rental expenses.
Right.
So you might block out, say, 10 weeks of the year. So 42 weeks worth of rental expenses are okay to claim. But just the 10 that you if it's not available for rent, it's not.
Right.
You technically can't do that. So they need you to apportion that. And then, but some people don't do it. They claim the whole lot. So that's something they're looking at. And then also in terms of the capital gains exemption for main residents, if you live in a family home, most people will be claiming that.
Yep.
It's one of the best tax incentives.
Yep.
But the intricacy is, if you were to use your main residence for income producing activities, if you have a dedicated room, a studio or a garage for your business, technically you'll lose. Like, you won't be able to access the whole 100% exemption. It would be it would be less because you use the property for income-producing activities. And then like another intricacy is like you don't even have to. It's not just that you go and claim expenses in relation to that property, like in terms of occupancy expenses. Like even if you don't claim anything, like but you use a part of your main residence for work, you still have to apportion it.
Okay. So, let's take that one step back where you said, for a holiday house where 10 weeks of it may be not vacant and you're using it as a holiday house and you can only claim a proportion of the expenses.
Yes.
How does that work with Airbnb then or short-term stay?
Yeah, so like short-term stays, I guess it's like specific, like you would work the same way. So the weeks that the property is available for rent, you're able to claim the associated expenses. So I guess it could still be vacant as such, but so long as it's on the portal and it's available for rent, it's okay. So it doesn't need to be occupied. But then the ATO has other rules, like you can't make the rent like absurdly high or like you can't inflate it. So like so long as its property is available for rent, you're able to claim it.
Yep. Okay. So if I 52 weeks of the year, 50 weeks of it is rented out as Airbnb as advertised. But if I live in it for 2 weeks as a holiday house, then I have to proportion that.
Yeah. In that situation, you have a very small amount of like non-deductible rental expenses.
Yep. Let's talk about. Now, you touch a bit on capital gains tax and all that for your own residence. Can you explain a bit about the 6-year rule?
Yeah, so basically, if you have a main residence and if you classify that you're living there, you do have the option to leave and live somewhere else and still choose that property to be your main residence.
Right.
So
what are the restrictions?
A classic example, would be. The classic example would be rent vesting.
Right.
So you might have purchased a property and then you lived in it like for a short period to establish as your main residence. But then you might go just to rent instead for the cash flow or other reasons, or you can move back into the family home. You can still choose that property to be your main residence for up to 6 years. So if you were to sell it in year 5, it would still be, even though it's tenanted, you would still get the full exemption.
Right.
And then I guess that's if it's tenanted, but you can, if it's vacant, if it's not subject to of like a tenancy or lease, it's indefinite. So if you buy a property, you lived in it for a short period, you have to establish the main residence first.
Yep.
So you can't go off the plan and straight to tenancy.
Yep.
Like you won't count. You have to be able to be in there for a short period of time to be to establish your main resident. And then from there on, if you lease it out, it's 6 years, or if you don't lease it out, either you leave it vacant, it's indefinite. But after the 6 years, you do have the option to move back in to reestablish, and then you get another 6 years after.
Right, that's my next question, right? If I want to be creative, I can live in it for 6 months, establish it as my owner occupied, then I rent somewhere else, live it for 6 years, but on the 6th year, I move back in there.
Yeah, you could do that.
And then live there for another 6 months, then move back out, so my 6 years starts again.
Yeah.
So essentially, I can have 12 years of capital growth and sell it down the track without paying any capital gains on the property.
Yeah, and like in that scenario, if you sell in year 10, like you will have the full exemption.
Right. So can I have the 6 year rule in that property, but also buy another PPOR, my main residence, in another street, like let's call it 2 streets down?
Yeah. So
does that work?
So if you imagine a timeline,
yep,
you can only have one main residence in any point in time.
Correct.
So if you buy another property, you can buy it, and then you can stop a main residence at any time if you live into that. If you move into the other property to establish that one, but ultimately you refer to the timeline and see from point A to B, this one is mine. And then when you have 2 properties, when you eventually sell one of them, it's judging the period that it's subject to. It's your main residence as opposed to the whole ownership period. Yep. And then that's how you work out capital gains.
Would it be the same if I moved interstate and purchased a property interstate for work purposes, and I lived, let's say for example, I had my main residence in Sydney. I moved to another state for work purposes, and I knew I was going to be there for 3-4 years. Okay, living upstate, and I purchased a property in the other state to live in, but I'm going to move back to Sydney before the 6 years. How would that work?
Yeah, so it would work the same way. So it has no bearing where you go. But yeah, like ultimately, if you establish that property as your main residence, you do have the option to continue electing for that property to be your main residence wherever you go. So you could go to another state. Yeah, that would be fine.
If I buy another property in another state, do I still get the 6-year rule exemption for my property in Sydney?
Yeah, if you choose so. So long as you don't select the new property that you've purchased as your main residence, you can still choose that.
Right. I got you. Well, that works out sometimes, doesn't it?
Yeah. Well, there's so many options when you have two properties because you can make, you could be your main residence and you might not choose it for the whole 6 years. You might find that the new property that you purchase is in a spot that's just absolutely growing.
Yeah.
It's got massive appreciations, and you might choose at that point that I want that one to be. I want that one to be my main residence from now. So it's just there's plenty of options.
So Jamie, let's talk about non-tax deductible and tax deductible debt. So, obviously non-tax deductible debt is, my owner occupied loan.
Yeah.
Right. I live in it. I've got a loan against it. It's for owner occupied use. Right. And I've got investment loans, which is tax deductible.
Yeah.
And let's talk about the tax deductible portion for an investment loan. Is there a certain structure that you will advise your clients if you should structure that loan as principal and interest or interest-only repayments?
So everyone's different. So it comes down to the specifics, but just generally, if you have a family home with a loan, and then also one investment property with a loan, it's usually better to pay off your main residence first. You pay it off quicker by having more repayments. So you go P&I. So you pay that off quicker. So in the life of the loan, there's lower interest, but that's okay because you can't claim it.
Yep.
So you keep the investment loan as interest only, and then for it's not going to be forever. It's
correct,
but just in the short term, it's better for cash flow. And then if you pay a little bit more interest, it doesn't matter because you can get a tax deduction for that investment property. So usually if you have a loan for a main residence and then also one investment property, or subsequently you have more than one investment properties, usually better to go interest only for those investment properties.
And that's what I say to a lot of the clients that we take on board sometimes, new clients that doesn't understand the logistics on the back end of that. It's like, Tony, but I'm not paying down my loans. I'm like, well, you are. It's just a matter of which portion of the loan you're paying down first.
Yeah, it's just priorities.
Right.
Yeah.
But as an aggregate, you are paying down the loan, but you're just prioritizing, like you said, it's paying down which portion of the loan first.
Exactly.
So there's no wrong way on, hey, should I have it as interest only or not?
It's just priorities. Like when you get a loan, your family homes, it'll be quite big. You rather focus on that one first.
Correct. Now we're talking about repayments, right? Let's say I don't have any non-tax deductible debt.
Yep.
All right. Now, is there a specific way, hey, do you know what? Should I go P&I repayments or interest only repayments if I had an investment?
Yeah, well, in that situation, it's you have you can go either. You can go either, and I guess it's based on your cash flow. If you have the capacity, I'd say there's no reason why you can't go P&I. You would go P&I to pay it off quicker. You would forego the additional rental deductions. You would forego the additional interest deductions. But still you would be better off because you're forking out $1 to the bank, but then you're recovering at your marginal tax rate. So it's still better to avoid the extra interest if you can.
Yeah.
So if you have the capacity, if you have the cash flow, go for P&I. But equally, if you have other commitments, you can go interest only as well.
Yeah,
give you a bit more flexibility, a bit more cash flow, and then interest only, it's not for the life of the loan.
Correct.
It's only a short period, and it has to go back to P&I.
Correct.
But it's just temporarily. If you have other commitments, that's a good way as well.
And sometimes I say to the customers, right, because the interest only rate is always going to be a little bit higher than the P&I.
That's right. Yeah.
Right. So I'm like, look, if you can afford the extra $200 a month or $300, whatever you want to call it, and it's sustainable for you, they go, look, just do it.
Yeah,
right? Especially when you have no non-tax deductible debt.
Yeah, exactly right. You'll put more. You would definitely avoid interest if you can.
So Jamie, Thanks for joining me on this podcast today. And I took a lot out of it, and I'm sure our audience did as well. So just our audience can find you and seek for your services. Where can they find you?
So just Google JMK Partners or visit jmkpartners.com.au.
Fantastic. Thanks for joining me, buddy.
Cheers, Tony. Thank you.
And guys, I'll see you next time.